Have you noticed something interesting? Every time the Federal Reserve cuts interest rates, Bitcoin tends to go up a lot. Is it a coincidence? Definitely not. There is a solid reason behind this pattern. Today I will explain this in a simple way. If you are interested in investing or crypto, you really want to understand this. Here is the quick summary. When the Fed cuts rates, that means borrowing money gets cheaper. Money becomes easier to get. When money is cheap, people and big institutions borrow more money. They want to invest it somewhere. They usually avoid low-return safe investments. Instead, they look for assets with higher returns. Bitcoin is a perfect example. It is risky, but it has high growth potential. This is why Bitcoin price often rises after a rate cut. When the Fed lowers rates, the cost to borrow money goes down. More money flows into the financial system. This extra money is called liquidity. With more liquidity, investors feel safer taking risks. They want to put their money in assets that can grow fast. Low-risk investments like government bonds pay very low interest. This makes high-risk assets like Bitcoin and technology stocks more attractive. Look at what happened in 2020. The Fed cut rates to nearly zero because of the pandemic. Bitcoin price jumped from around $5,000 to over $60,000. A similar pattern appeared again in late 2023 and early 2024. Even before the Fed officially cut rates, Bitcoin price started to rise significantly. This shows the market reacts to expectations of rate cuts as well. Lower interest rates usually mean the Fed will print more money. This printing of money is known as quantitative easing. More money in the system can cause the US dollar to lose value. When the dollar weakens, investors worry about inflation. Inflation means money loses buying power over time. To protect their wealth, investors look for hard assets. Hard assets keep their value better than cash. Gold is a traditional choice for this. Bitcoin is becoming known as digital gold. Bitcoin has a fixed supply of only 21 million coins. This scarcity makes Bitcoin attractive as a store of value. It acts as a hedge against inflation and dollar depreciation. When the Fed lowers rates, bond yields go down. This means investors get less interest from government bonds. For example, a 10-year Treasury bond might pay only 2% annual interest. At the same time, Bitcoin price can rise 30% or more in a few months. Many investors, especially younger ones, see Bitcoin as a better option. Institutions also recognize this trend. They move money from bonds into Bitcoin and other growth assets. This is not gambling, it is smart portfolio management based on returns and risk. Big institutional investors do not wait for the Fed to actually cut rates. They try to predict when cuts will happen and position their portfolios early. For example, in early 2024, before any official cuts were announced, large firms like BlackRock, Fidelity, and others started buying Bitcoin ETFs. Bitcoin ETFs allow investors to buy Bitcoin through regulated financial products. By May 2024, these ETFs held over 850,000 Bitcoin coins. This shows real big money is moving into Bitcoin. These large purchases help push the price higher. Retail investors often follow the moves of institutions. To sum up, when the Fed cuts rates, money becomes cheaper and more available. Investors look for better returns and take more risks. They put money into Bitcoin and similar assets. Concerns about the dollar losing value make Bitcoin more attractive. Government bonds pay less, so investors move money to riskier assets. Large institutional investors act early and drive the market. All these factors together explain why Bitcoin often rises when rates fall. If you found this video helpful, please like and subscribe for more crypto insights. Next video will cover who is buying Bitcoin at $110,000. Stay tuned and thanks for watching.